Okay, you're right. Good morning, everyone. It's Bryan Stott here from Wren Sterling, just introducing this morning's webinar on business lifecycle planning, steps to take if you're 3 years from a sale. So that's what we're going to be discussing this morning. There is a facility to type in any questions you have. If applicable, we will take those questions during that talk to you this morning, or we'll take them at the end if we think that's the right thing to do. But there is a facility to ask questions. Now, I'm sitting here this morning with Steve Blissett he's one of the directors of Rodliffe Accounting, who will be doing most of the talking this morning. I think my role when I go and see as a corporate consultant, when I'm traveling around the country talking to business owners, one of the questions that often pops up is, or I may ask, well, what is your business worth? And sometimes when I'm talking to the owners, they don't know, or they have a figure in mind, they think that's about right. But my reply is always, your business is only worth as much as someone is prepared to pay for it. And there's two sides to a sale. There is you, the business owner, who wants the highest price possible. And then there's the buyer who wants to buy it at the lowest price possible. And you often meet somewhere in between. What we're going to talk to you about today is what you as the seller need to consider. So without further ado, I'm going to pass over to Steve, who starts. Okay, Steve, over to you.
Thank you very much, Brian. Good morning, everybody. So on today's agenda, preparing to sell your business, the longer lead time you have to enable you to prepare to sell, then probably the better sales price you'll get, and the better and the higher valuation. Secondly, is there a right time to sell? Thirdly, business valuation itself, and then linked with that, after you've sold, what tax are you likely to pay? Brian will then talk about wealth planning, including retirement goals. Also, there'll be an insurance review, something that's very important to make sure you've got in place before you sell. Succession planning, and then a 3-year revenue plan. So preparing to sell your business, due diligence is an important part of this, often referred to as a health check. So something that you will have to do or ask advisors like us to help you with is just to make sure you've got everything in place, and just to make sure that your books look straight, for example, and your contracts are in place, and your legal issues and company house issues are all in line. So that's the health check, a due diligence check. Have you got healthy, up-to-date financials and legals? So healthy, up-to-date financials would be, are your accounts up to date? Are your VAT returns up to date? All those obvious things, but also things that might be slightly less obvious, like have you got a true valuation of your assets, for example, on your balance sheet? The legals are important too. Have you got contracts in place? Are your warranties okay? You don't want to pass anything over to a buyer that could potentially be flagged after the sale or during the sales process itself. Something that's often overlooked is IT systems. Are they all up to date? Do they all work? Have you got any legacy data that a buyer might look at and think, what do I do with all this information? So having all your IT systems working well, could you tweak them? Could you perhaps look at some integration, perhaps over a 3-year period, to make them work more effectively? As I mentioned earlier, contracts with staff, contracts with third parties, HR contracts, your staff file, is that all up to date? All these things are important. Would you pass a home office visit, for example, if they were to arrive unannounced at your front door? Very important to keep focused on the business. It's easy, just a bit like when you're selling a house. It's a bit like, I suppose you get preoccupied with selling the house and not necessarily focus on upkeep, maybe. So you need to keep really focused on the business, not just the sale. Also importantly, remember you could have an earn-out clause in the contract. So when the contract is drawn up between yourself as the seller and the buyer, you may be required to stay on perhaps for 12 months, maybe even 24 months to make sure that the handover goes very smoothly. So is there a right time to sell? I suppose in a nutshell, the best time to sell is when the business is worth the most. And this is why we talk about a 3-year plan. The more you plan this, the higher the valuation is likely to be. Obviously, a bad time to sell is if your sales are on the decline and your profits are dipping too. That would be very evident to a buyer and it would affect the price. If you've got a situation like that and we can turn it around in a 3-year period, then that will be great. And then all of a sudden you now have a good time to sell. So the business needs to be healthy, sales increasing and profits and market growth increasing. Business valuation. Of course, if you ask 8 different accountants to value a business, they will come up with 8 different answers. There is a science behind it. There's many methodologies that can be adopted in order to arrive at the correct, in inverted commas, valuation. But as Bryan said right at the very beginning, the valuation is just a bit like, again, selling a house. That's your value that you place on a business, but it all really hinges on what a buyer is prepared to pay, I should say. So key things to look at when you're valuing a business would be obvious things, I guess. What's the underlying profit, and are there any risks to this profit moving forward? For example, if you take you out of the equation, if you take a key member of staff out of the equation, for example, is there a risk to that performance? EBITDA is often referred to. That's earnings before interest, tax, depreciation and amortization. Bit of a long acronym, but that's an important measure and it sits within your profit and loss account. And that's something that buyers will be interested in so that they can compare you with other similar businesses. We also have to think, when we're looking at evaluation, we have to look at the market overall and competitor trends, and these comparisons are very important. Earnings multiples are often used to help with evaluation. So for example, you might have earnings of, I don't know, £1 million, say, for example, and the earnings ratio that's relevant for your business could be ×3, in which case a very simple valuation would be £3 million. More complex than that, but earnings multiples do take into account the market that you're in, and to some extent, therefore, your competitors. Cash flow and forecasts are very important. Often when we look at a company who are thinking about selling, their forecasts can be very illuminating. Typically, the forecasts that we see are probably very, very optimistic. So it has to be something that's well thought out and substantiated with, I don't know, an order book, for example, recurring revenue, for example, anything that gives it credence. And of course, it's not just all about the numbers. Also your brand, your know-how and customer satisfaction. Are your customers happy? Are they loyal? These kind of things are very important for the valuation itself. When you've sold the business, the tax that you pay will depend on a number of scenarios. The first thing to think about is how you sell. I mentioned an earn-out period earlier, which could well be in the contract between yourself and the buyer. That could include cash over a 12 or 24-month period. Might be cash up front. There could be some shares involved. So, for example, it could be 50% cash sale, 50% share sale in the new business. Or it could be a mix of all those. There could be loans in there as well, or loan notes, convertible loan notes they're called. Depending on how the business is sold and the type of consideration that you get will determine whether it's income tax or indeed capital gains tax that you pay. If you sell the business as a going concern all in one big lump, if you like, then you may well be entitled to entrepreneur's relief, which is capital gains tax at 10%, which is very attractive. And again, with a 3-year period to plan for this sort of thing, that's something that we can think about and also advise you on. Okay, that's my little bit over. I'll hand you back to Bryan to talk through wealth planning.
Thanks very much, Steve. Okay, so when we talk about wealth planning, it's, what are your objectives? Are you just going to sell your business and travel the world and spend all your money? You really need to think, what are you going to do? What lump sums do you want, and what are your income requirements? So once you know that, what you want to do, then are you on target? Are you going to achieve what you want to? Especially when you think, okay, my business worth 1.5 million, say, when I sell it, but in reality you only get 750,000. What are you going to do about that? So all we're saying is, do you know what you want? Maybe you do, maybe you don't, or do you have an idea of what you want? So that's the first thing. Then do you have the right strategies and investments in place to get where you want to be? And then also is, so when you're sort of like trying to achieve all your goals, there's a lot of tax efficient investments. So I talk to a lot of business owners and say, look, pensions are a complete waste of time. The business is my pension, because when they're going to sell, they're going to get a nice lump sum of money. But there's lots of tax efficiency now in investment, in pensions, especially with the change in dividends. And we are finding that business owners are looking more at pensions. Then when we're looking at more exotic investments such as venture capital trusts, enterprise investment schemes, maybe these are for more when you've sold your business and you've got your lump sum, because these schemes can attract up to 20 or 30% tax relief. They're not for everyone because they could be a bit more high risk, but all we are saying is, look, if you sell your business for a lot of money, where do you put it? How do you get the best tax treatment? And maybe you should be planning as you're leading up to selling your business and when you sold it, so you have some strategies to know what you'll be doing and the best taxation methods for yourself. And then inheritance tax, have you planned for this? Do you have anything in place? What are you going to, will this need reviewing? And like everything as well, wills, do you have a business will? What happens if, unfortunately, something happens to you before you actually, make it to retirement and selling your business? And will these need changing with the change in your staff? I guess they will do. All we're saying is, look, it's quite clear, really. Do you have the right strategies in place for what you want to achieve? And everybody's different. That's what we found. So you really need to really sit down and say, what do I want to achieve? Am I on target for what I want to do? And when I talk to people, I think when I'm talking to people, you need to know your options, really. If I do this, what are the pros, what are the cons? Or if I did this, it's understanding the options, and then you can make a decision. So before you start selling your business, really, is, do you need to review these things? Every employer should have articles, well, every limited company has articles of association. Have you read your articles? Are they the standard or are they bespoke? But when I talk to lots of business owners, none of them have ever read these articles. Do you have agreements in place? If you've got fellow shareholders with small percentages, what are the agreements if you sell? What do they actually get? Are they up to date? Share protection, what does that mean, in fact? What we're saying is that if you've got a business valued today at £1 million and your shares are, say, 75% of that, so your net worth is £750,000. And in the event of your death, that passed to your spouse or your dependents. However, what happens if something happens to you and you die? Your shares might be valueless. So How do you protect the value of your shares? Key person, as Steve said earlier, if you're looking to sell your business, is there someone very key to your profit? I would hope that when you're nearing to selling your business, that you have no need for key person, because you should have structured your business in the correct way, that really all you want to do is to be able to walk away, and you just sell your business, and business carries on as per normal without a key person. So, you need to understand, yes, it is important for many businesses, but in my view, you have to look at it, is this really needed? Sometimes it is, and sometimes you just need it for instance, if you've got a large contract that's going to earn you quite a bit of money over 1 or 2 years, and there's one person who's key to that contract, maybe you need to do something for them. We're talking about relevant life. That's just a very tax efficient life insurance. I'm not going to say that. But what we're saying is really, you need to review everything, in our view, when you're selling. Maybe everything is nice and neat, and it'd be nice to have the comfort that you are on track for what you want to do, everything's in place. But if it isn't, we can help you. Other considerations when you're selling: general insurance. Do you have the right cover? This is quite important when you're selling your businesses. Auto-enrollment, what a nightmare for many small companies. Are you compliant? What you don't want is someone to come in, you've got, say, 10 employees where you can be fined £500 per day if you're not compliant. This can have a serious effect. And employee benefits, are they value for money? That's what maybe a buyer would be looking at, and not so much a seller. But are they set up on the most tax efficient basis? All we're saying is, look, you should review things that you have got in place, and maybe talk to someone about other things that are available for you. Okay, so I'm going to pass back to Steve now.
One thing that I mentioned at the start, there's a 3-year revenue plan. So once you've made the decision that you want to sell, and you've started the process by perhaps talking to advisors like us who can help, then you need this plan. And if you can come up with a plan that's reliable, that's got credibility, and then measure yourself against it, then this will really help you grow. So there are a few key stages to this. You need up-to-date accounts. What really helps, we found, with this process is being on the cloud, and there are many bookkeeping and accounting pieces of software out there that are very good, and they keep you up to date. One of the things that they do, Xero, for example, is you can have overnight bank feeds. So every morning you've got a snapshot of your business that's up to date. That really helps keep you on track. When you're coming up with a revenue plan, start with sales. Come up with the most likely prediction. So you don't want something that's too pessimistic, and equally, and probably even worse in many respects, you don't want something that's too optimistic. So you want sales that are most likely. So think about loyalty of your customers. Think about sales that repeat or recur if you're in that fortunate position. Think of it that way, and then come up with the most likely sales prediction. And that will need to be by month. So 36 months to cover the 3-year revenue plan. When you come up with the most likely sales prediction, then what are your costs going to be to underpin those sales? And their costs typically fall into 3 sort of areas, if you like. There are those costs that vary directly with sales. And as you know, as retailers, stock purchases, that's a very good example of costs that will vary predictably with sales. Then you've got things like stepped costs, and that could be a member of staff. So if your sales are likely to grow by, I don't know, 10, 20%, let's say, over a 3-year time frame, then you may need an extra person, and that extra person themselves bring along with them additional costs, like pension costs. Bryan mentioned auto-enrollment earlier. So you may have to include those costs, national insurance, and 1 or 2 other costs that come with a member of staff. And then, of course, there are fixed costs. So typically, no matter what your sales forecast is, those costs remain the same. So rent, rates, perhaps heating, lighting, that kind of thing. You then need to test how reliable this forecast is. The best way to do that, of course, is measure your actual performance against the forecast. Do it every month or at least every quarter. And again, if you have cloud-based bookkeeping software where you've got an up-to-date dashboard of your accounts in front of you all the time, then that's an awful lot easier. And then implement this plan to achieve this. So there might be other things that you need to do in order to implement this revenue plan. So you might need to think about, I don't know, do you manage your stock a little bit better to help you with the plan? Maybe you need to upgrade your EPOS system because that might help. So that's part of the implementation.
Okay, so hopefully this just gives you a very simplistic overview of the things that you need to consider. So we're happy to have an initial consultation with you and to discuss anything. What we will do is we will send these slides out to you. And we're also offering, I think the first thing you probably need to understand is, or look at, is valuing your business. Now, we have a free valuation tool. It takes probably 20 to 30 minutes to complete, so it's quite comprehensive. If you are interested in just getting an initial valuation for your business, please email either Steve or myself, and we'll send you a link so that you can have this free. So, and if you want any other further information, please either email us or call. But later today, you will be getting this presentation or by the latest tomorrow. So, I'm not sure whether we got any questions at all, but I'll just check.
We could follow up with an FAQ, couldn't we?
No, we have no questions. So we'll just stay open. If anyone wants to ask any questions now, please let us know. Okay, well, thanks for your time today, and please contact us if you have any questions. Thank you. Bye.